Hello and welcome to another Property Solvers podcast. This is episode 8. I'm here, this is Ruban Selvanayagam from Property Solvers. I'm here with James Durr. How are you doing today, James?
I'm good. Yourself, Ruben?
Yeah, all good, thanks. Okay, so today is a conversation that I thought would be of interest because my knowledge of the whole topic is pretty limited relative to James. So again, this is probably going to be a podcast that's focused on me quizzing James for the majority, I'd imagine. The topic is going to be investing in the stock market versus the property market. So James, as some of you would know, I've known for a long time, best part of 20 years, probably more actually, showing our age again. And James has always had an interest in the stock market in addition to property. So I thought we would have a bit of a discussion with regards to the overlaps between the two areas. So James, do you want to maybe give a little bit of background as to what you've done in the stock market over the years and how it's kind of complemented your investing activity in the property sector?
Yeah, well, Ruben, first of all, thanks for the introduction. You make me sound like I'm some kind of fund manager managing hundreds of millions of pounds, but
yeah, I would say just to stop you there, James, quickly, this is not financial advice, and we strongly encourage listeners to undertake their own due diligence and research. So yeah, I just wanted to put that disclaimer in before we go ahead. So yeah, sorry, James, go ahead.
Yeah, actually, funnily enough, I bought my first stocks before I bought my first property. I first invested in stocks back when I was maybe 16. And originally, actually, my dad got me into it because he said at the time that anything I make, he'd double, which if there's any parents out there, it's a pretty good incentive to get your kids interested in the financial markets. So yeah, I mean, and the first trade I ever did, I don't know, I made like 150 quid. I mean, probably in real terms, I probably lost money with trading charges back then, but that's what my dad gave me at the time.
No, not bad for a 16-year-old. Yeah.
Yeah, I mean, I hadn't put in that much money. I mean, I'd maybe put in like 150 quid or something, 200 quid, I can't even remember. But it was small money, but it did get me interested in the stock market. And basically, since then, I've always had it as a sort of like an additional little income stream, not even income stream, investment more like, that I put like pension contributions, like using a SIP into the stock market. And I'd also use my ISA allowances and stuff just to be as tax efficient as possible. Because obviously you can save tax from that way. I think with a SIP, like if you're a higher rate taxpayer at the moment, there is some very good savings that can be made because obviously you can bring down your taxable income by putting money into your SIP and then investing it in the stock market. So right now, when it's, when interest rates are so high and the tax bills are so high based on revenue from rentals, it makes a lot of sense to put money into a SIP at the moment.
And SASs
in saying that,
yeah.
Sorry, Ruben?
And SASs as well.
Yeah, SASs, as far as I know, is more for like companies. So you can, like, if you're investing through a company, you can use a SAS, and then you can actually use a SAS to also buy commercial property, but obviously also to invest in the stock market. Yeah. What I would say is the stock market as a percentage of my overall net worth is a very small percentage. So obviously I have a big leaning towards property for what I prefer to invest in. However, for some diversification, it is good to sort of have a percentage of your income in stocks. And obviously there's a few different ways that you can do it in terms of like whether you buy single stocks, whether you invest in index funds, and the returns that you could expect from the different strategies.
Yeah, I think index funds is probably the one that appeals to me the most because it seems to be the investment strategy that's a bit more set and forget. and you don't have to jump onto AJ Bell or, these different platforms to kind of see how your investments are performing. You just kind of leave it there and let it do its thing over time. There's going to be ups and downs, which you just kind of grin and bear. But long term, they tend to go up. So I think those are the kind of things that appeal to me more. I mean, also, some of the other benefits that I see from the stock market are, the relatively low frictional costs compared to the property market. Property is a great asset, obviously. We've got a low supply of housing in the UK, so it's pretty much guaranteed to always go up in value in the long term. And you've got a tangible asset there. But then there are issues, particularly at the moment. You just mentioned tax. Obviously, the cost of kind of getting into any kind of deal really is quite expensive these days, from fees to legal costs, stamp duty, which as an investor, you're effectively paying double because you've got the surcharge. So the stock market relative to the property market is a lot easier to get into. Just for me, looking at individual stocks always seems a little bit more risky because I just don't feel confident enough to do it, because I don't know enough about the companies, and I always feel like I need to have a good understanding about each company before, or each kind of stock that you're investing in, before putting any money in, really, because if not, you're just kind of not throwing your money away, but you're taking a bit of a risk if you don't really know what you're doing. So would you agree with that, James? Would you agree that like the kind of due diligence is really important when investing in the stock market?
Yeah, I mean, I'd say if you know how to read a company balance sheet, that goes a long way to understanding stocks that you're buying in the stock market, because ultimately that's what it is. You're buying a share of a company. So as long as you're able to understand the metrics, I mean, the metrics might be they might be displayed a little bit differently, and you're looking at things like price to earnings ratio and price to sales, book value, these kind of valuation metrics that you look at when you're looking at stocks. They might not be quite as, I mean, it's a similar thing that you'd be looking at when you're looking at your own company balance sheet, right? What your earnings are going to be, basically what your earnings per share are. So I do think that a lot of the skills that you would have from sort of running your own business, understanding finance and balance sheets, are transferable to the stock market. But in saying that, if you're not used to like accountancy speak and looking at these valuation metrics, it can appear to be quite daunting to get into the stock market. And how you choose to invest in the stock market also depends a lot on, number one, like what is your understanding of how to value companies? What is your appetite for risk? Because obviously, there's different types of companies and there's different types of strategies within the stock market. Do you want to go for like high growth companies? Like in a high growth company, maybe they mightn't have a dividend. Maybe their balance sheet mightn't look as good as a sort of a long established company, because they're reinvesting a lot of their profits and they're using that to grow. So obviously, I mean, if you're younger, or you're a bit more, you've got more of a risk appetite, or you don't mind losing money as much, you might choose to invest in sort of growth stocks where, you get to kind of, you're looking to like double your money or 5x your money in a few years. You don't mind taking more risk to go for a more aggressive strategy. As opposed to, you could invest in like your stable sort of dividend stocks, or simply just choose like an index fund that tracks the market. And actually, there's been a lot of studies done on how index perform over time, and I think they've back tested for like 100 years. And an index fund will outperform 90% of fund managers and stock pickers. So if you don't know anything about stocks, there is something to be said about just dollar cost averaging over a period of time and just buying into an index fund.
And what is dollar and pound cost averaging? Can you describe that a little bit more?
So pound cost averaging or dollar cost averaging is just simply like obviously it's very difficult to pick the top or the bottom. It's impossible. You can't pick the top or the bottom of any market or any stock. So the idea of dollar cost averaging or pound cost averaging is just, let's say you've 100,000 to invest in the stock market. Instead of investing it all in one go, because there's a risk that maybe you've invested at a high, you would invest, let's say, 10,000 a month over 10 months. So, you would have hoped that maybe there's a range of prices that you'll have bought at, which will hopefully smooth out like any potential losses or gains that you've made from buying the stock at the wrong price. And obviously, like I've taken an example of 10 months there, but really you'd want to do this over years, So like if you were paying, for example, out of into your pension, like you put a certain amount of money aside every month,
right?
And you consistently buy one of those index funds over a period of years, and then obviously you've made sure that while maybe at some points you've bought at the top, you've also bought at the bottom, and overall you should broadly be able to perform in line with the market. But yeah, just a couple more stats on like what I've done briefly is just look at like the last 70 years in the UK to see basically how the various indexes have performed, to give you sort of an idea. And actually property has far exceeded the FTSE 30. It's the FTSE 100 now, obviously, but the only thing you could back test is for the 30, like the oldest index in the UK, which is the FTSE 30, which is the 30 largest companies in the UK. And over the last 30 years, that's only returned 4.4%. Now, I don't think that figure includes dividends. But if you compare that to property over the time, property has performed at 7.3% compound annual growth rate.
Is that real? Real based on inflation adjusted.
I think these are inflated adjusted figures.
Right.
I've just pulled them up now, but pretty sure. Just check.
Yeah, they do tend to be more volatile, when you get kind of geopolitical issues and, black swan events like COVID, you tend to see the stock market just crashing at a real crazy pace, whereas property tends to, obviously there are dips, peaks and troughs, but the volatility doesn't seem to be as pronounced.
Yeah, I'm pretty sure it doesn't actually specify in the article I'm looking at, but I'm pretty sure these are in real terms. But yeah, even if they were in nominal terms, it still shows the point the same, right? Which is that property has outperformed the FTSE. But again, I'm not sure if that FTSE figure has included dividends from stocks.
Right.
So you'd have to think about that. But I mean, some of the other indexes, like you got the Dow Jones, 7% annual compound growth. The Nikkei 225, 6.5, gold 5.8% compound annual growth. Inflation over that time has been 5.1% annually. So yeah, it must be it's adjusted for inflation. And then, believe it or not, cash has actually linked to the. Just got it's performed at 6.1. So I guess that must be talking about I mean, due to the double-digit interest rates of the 70s and 80s, the UK really got a hold of inflation. So obviously that's made cash perform well. But over the next 5-10 years, I mean, these figures could change dramatically. And obviously cash isn't going to perform as well in a period of really high inflation, which we've had recently. But for me, this doesn't really show the real advantage of property and why I'm so much heavily weighted in property, which is the ability to leverage your money. So although there are various tools in the stock market like CFDs and options, they tend to be a little bit more complicated, a lot more risky. And your gains can be bigger, but your losses can also be bigger. And they're not for the faint-hearted to trade those kind of tools. So like, whereas a mortgage, everybody can understand, right? Like, so, like if you've got 100,000 and you want to invest it in property, you're going to be able to buy a property probably of about, let's say, 400,000. Whereas, like, let's say if you have 100,000 and you invest that in the stock market, and let's say you get 10% return in the stock market, your 100,000 will be worth 110,000 at the end of year one. If you get the same return in the property market, because you've leveraged up that money and you've borrowed the extra 300, you're still getting the capital growth on the full value. So effectively, you would have made 40,000 on a 400,000 property. Still using 100,000 investment, and that is a real secret and the reason why I'm so heavily weighted into property.
Yeah. Despite all the taxes and all the issues that we face as property investors, that makes a lot of sense.
I mean, there's been periods. Don't get me wrong. I mean, there's been periods where I've thought, like, particularly in the last couple of years, like, why am I so heavily weighted in property when, like, I'm looking at some of my investments that I've made in the stock market and, like, I've done absolutely nothing. And, like, even an index fund that I've invested in a couple of years ago is up like 92% or something in like 2-3 years,
Which one was that, James?
I think it was, it might have been, I think it was some worldwide fund minus UK, something like that.
Right.
I'd have to look into that.
90%, wow.
I mean, or like I made a Tesla investment in 2019 and that's up like 500%. And you look at like these kind of returns in the stock market and they are available and like they do happen from time to time. Whereas like, that's very unusual to get those high returns in such a quick period of time with property. But equally, like Tesla's example, it's down 30% this year alone, and drawdowns like that are quite common in the stock market. So really, you need to be in it for the long term. You need to be able to accept the peaks and troughs that come along with investing in stocks. You need to go in with your eyes wide open. Obviously, you need to decide what your strategy is going to be. Are you going to be an active investor and pick your own stocks? In which case, you need to know about like valuation metrics. You need to know how to value stocks, how to value companies. When are you going to buy them? Are you going to be like a counter-cyclical investor? Some people like do really well from buying good companies when they've had a bit of bad news. So. I mean,
that's probably the best time to kind of get involved, right? I'd imagine when there's kind of a
I mean, it can be, unless the bad news actually means that the company, like, you've got to distinguish like what's bad news that's been like overbaked into the share price, and maybe it's not as serious as like the drop in share price that it's taken, and it's still a great company. But sometimes, obviously, a company will drop a lot on bad news, but the bad news is a sign that there is something really badly wrong with that company. And obviously, if you buy into that company, I mean, you're in trouble. I mean, if you look at like, let's say, purple bricks. I mean, if you bought into that, like within the last couple of years, I think it went to a high of something like 530, and it went down to like 15p or something at the moment. So you can really get destroyed in the stock market if you pick the wrong stock. So I would say generally, if you're going to get involved in the stock market, you're better off getting involved in index funds, dollar cost averaging, unless you feel that you've got an edge on a particular stock, or you've got some knowledge, or you've really delved into the financials of a company. And you feel like, you've got really high conviction over a certain company, then you can start picking stocks. But you've got to be
that comes down to time. Comes down to time and being able to like spend time and researching these companies. Watching the news and
and whether you want to do that. whether you want to do that. And also, even if you do that, you're still not guaranteed that you're going to outperform the market or outperform the index, you know?
Yeah.
So you got to look at all these things.
Yeah.
And make your decision what works best for you based on your risk profile and what returns you're looking for as well.
Sure. Okay, and to kind of conclude, I know you've dabbled in it. I've always stayed away from it. What are your thoughts on crypto, James?
Cryptos.
I know you've always done it at a very kind of low key level. You've never been all in. But yeah, it'd be interesting to know what your thoughts are.
Crypto, I always seem late to the party, you know? Like, I mean, I was looking at Bitcoin in like 2016, 2017, delaying, just thinking, how is this going up so fast? And it's just kept on going. And obviously, like, it's been the best performing asset by a mile in the last 15 years. Would have destroyed your returns in property, the stock market, everything. And I think crypto, for me, it still feels like it's very difficult to place an inherent value on any of these crypto projects. I just think they're really impossible. What's that?
Even Bitcoin.
Yeah, even Bitcoin
seems to be gaining traction. You know, I know there's some ETFs around in the space and that kind of thing. Do you even still?
Yeah, I mean, it's just like, how do you value it when it's got no income, it's got no revenue? I mean, the only sort of way that you could probably think about valuing it is like on total supply, which I think, I can't even remember how many Bitcoins. Is it 36 million or something? I could be wrong on that. But yeah, I mean, and from a supply and demand sort of point of view, you know, at a real sort of macro level. But personally, for me, I think crypto in general is really difficult, if not impossible, to value. And to me, it seems to operate on a greater fools theory, where you can make an insane amount of money. And like you said, I've actually gotten involved in crypto most of like the bull runs in the last sort of 6-7 years. And I've tried to get in and out quick. And I've actually been successful in making money in it, but I've also left a lot of money on the table at that time. And for me, I think crypto is okay if you don't mind losing the money, and if you're you want a seriously aggressive strategy to building wealth, you know. So, like, I mean, personally, if I just had like 50,000 to invest and the choice was crypto or property, I definitely pick property. But like, if I've got some spare money to gamble with, and I want to make big returns, there's no other place where you're going to get like 20, 30, 100x in like less than a year. You know, that's crypto. So I can totally understand why people are getting involved in it, and it's very alluring, these gains. But obviously you can lose your shirt, and to me it's gambling. But it's been a very asymmetric gamble the last 15 years, in the fact that, like, basically if you bought like most of the top coins, you probably would have made money. I remember
when you first started getting involved with it. Well, when we were talking about it a little bit back in kind of 2017, and it was around 17,000. And what is it now? 60,000, something like that. Dollars. So it's
like 70,000 now. It's hovering around 70,000.
Yeah. So,
but I would say at
that time, everyone was saying it's peaked. You know, it's like, you know, it's just crazy to see how it's.
I mean, I would say that like Bitcoin now, I mean, it still feels as risky to me, like, to buy Bitcoin. And like, if I'm buying crypto now, I'm looking at some of like the altcoins, like further down, like the smaller projects where you can get the 20, 30x gains. Because if I'm going to bet on crypto, I want like a really high rate of return. And for me, in Bitcoin, like, I mean, this bull run, I think Bitcoin went down to 15,000. Okay, it's at 70,000 like now. So it's like, what's that, like a 5x almost? But in that time, like maybe you would have some of the altcoins, like, you know, like not even like some of the well-established altcoins could have 10x in that time. So I'd be more interested in looking at altcoins, but yeah,
they come with their own.
Pay your money chances in crypto.
Yeah, exactly. I mean, a lot of those altcoins have fallen by the wayside as well, right? Over the years, they've been doing well, and then they've suddenly
some of them go to zero. I mean,
yeah.
You could almost
been sorry, James, go on.
No, I was going to say, like, I remember a friend of ours, Ruban, shout out to Big Sean, in the last crypto bull run, he just basically picked like a portfolio of like 15. It was called the shitcoin portfolio, and he had 15 coins like randomly selected, and they were all under 1 cent. And I think the portfolio was up like 350%, 400%. Before it crashed.
Wow.
But like it was working, you know, and like there was absolutely zero research done. His only research was, let's find coins less than 1 cent and build a portfolio with them, you know?
Yeah.
I mean, he didn't risk much money.
Yeah.
Obviously, I don't think he'd mind me telling the story, because I mean, he didn't give a shit either when most of them went to zero.
Yeah.
But it does show you what is happening in the crypto market. And there's a hell of a lot of charlatans out there in crypto, and a lot of those projects are duds. Loads of them are going to go to zero. But if you fancy a gamble and you feel like YOLO, and a few quid into them, then go for it.
Yeah, it's effectively a trip down to the casino, isn't it? That's what you're doing.
Yeah.
Yeah. Well, James, this has been super interesting for me, someone who doesn't have that much knowledge in all of this. So yeah, really appreciate your comments and discussion here. So yeah, if anyone's got any questions for us, or probably James specifically, yeah, feel free to DM us on LinkedIn. Probably that's probably the easiest way to get through to us. Yeah, always open to more topics and discussions, and yeah, feel free to reach out to us. And yeah, as always, please like and subscribe. Thanks very much.
Thanks, guys.
Bye.